I went back and looked at everything I could possibly find, and this is the most negative sentiment in the history of markets. Pretty much, right? What it is, and I kind of distilled my thinking down, is what is GDP? GDP, essentially GDP growth over time, not, quarter by quarter, is driven by demographics, i.e. population growth, plus productivity. That's the kind of magic formula. Once you understand that, you can build a framework around it. And the framework of understanding is, as I've been talking about, demographics as a net draw. And I know there's some arguments out there from others that maybe the capital gets released by the baby boomers and it could be inflationary. There's no evidence of that anywhere in the world yet. So, that's a risk to the view, and that's fine. So demographics is a real problem for the Western world plus China, plus Southeast Asia. Aging populations mean GDP growth goes down. What we've seen is because of globalization, technology, and too many people in the workforce at the same age, the baby boomers, they've competed for wages, and real wage growth has been flat for 40 years. So i.e. the average American has had zero increase in wages. And the second drive why that's occurring is obviously the competition at wage level, i.e. 76 million boomers competing with each other and now competing with their kids. They're both in the labour force at the same time, competing with AI, robots, the internet and everything else, competing with Chinese workers and Indian workers. I mean, that's a pretty difficult environment for everybody.
Hello everyone, and welcome to the Daily Crypto. We are back with another video and are joined by the founder of Real Vision, Raoul Pal. He is going to share his outlook on the global economy with us, so make sure to watch the full video because this could be your chance to short the market and make a lot of money. But before we can continue with the rest of the video, let's take a look at the Fear and Greed Index for today. As of recording this video, it is sitting at 40, up slightly from yesterday's 38. This indicates that investors have started to become more greedy and are actively investing their money to make some gains. Currently, Bitcoin and Ethereum are trading for $21,230 and $1,612 respectively. With that out of the way, let's continue with the rest of the interview. The demographic problem is very real, and it is a rapidly growing concern. As the average population age increases, the GDP goes down because more and more people are looking to retire and stop working. However, it is further affected by the fact that boomers and baby boomers are now competing against each other while wages haven't grown much. This creates a high debt environment and is one of the major reasons why the US debt is spiraling out of control.
GDP growth has been falling over time. And what has happened is everybody's taken on debt to offset it, whether it's governments or whether it's individuals or corporations. So everyone's been taking on debt, which offsets the decline in GDP. Problem is each dollar of debt is driving less GDP each time. So it takes, I think, $1 of debt to drive $3 of debt to drive 1 unit of GDP right now. So it's been falling over time. So how the fuck do you solve a problem like this? It's a real issue. Now, the issue is the debt part of the burden is something that is potentially solvable. So how do you reduce that debt burden to free up capital and, velocity and all of the things that you kind of need to get the economy driving? And to free that up, you're going to have to either pay back the debt, which is never going to happen. You're going to have to inflate it away with headline inflation, which is happening now, which is too societally painful. So the central bank quashes it immediately. Or 3, you have to run negative real rates for extended periods of time, much like the 1950s.
As the debt continues to rise, the GDP growth slows down because to increase GDP by 1 unit, $3 of debt have to be brought into the system, and it is gradually decreasing. To solve this problem, Raoul says there are only 3 solutions. One of them is to pay back all the US debt, which is out of the question, or increase inflation at the cost of consumer pain, and lastly, run negative interest rates.
The election cycle and where we are, I think the propensity for the government or the Federal Reserve to accept a rise in unemployment that's larger than, enough to get them go back to cowbell, I think it's unacceptable to them. It's unacceptable. Society can't take this kind of shit right now, and I think they know it. So I don't think that those passive flows disappear. I do think unemployment picks up. I've got some indicators that say it picks up a lot, but my guess is this recession is actually faster than people expect. So it'll be over with. Yes, we'll have a drag. Yes, unemployment goes up and things settle down a bit. The equity market, I mean, I went through this in excruciating detail in GMI, and I went back and looked at everything I could possibly find, and this is the most negative sentiment in the history of markets. Pretty much, right? And so the argument is, from every single person, is yes, but earnings. So let's question that narrative. Could they be right? Of course they could be right.
Raoul believes this recession will be the worst that we have seen in a very long time, as it will be accelerated by rising unemployment. Some of his indicators are suggesting that it will increase at a rapid pace, which will serve as a catalyst for a financial crisis. However, a lot of other market analysts argue that earnings are looking positive, which, to be fair, is a very valid point. This is what Raoul has to say about it.
Could they be right? Of course they could be right. There's no certainties, and none of us believe that we know the truth. But if I look at the year-on-year rate of change of the S&P or the Nasdaq, they're pretty consistent with the S&P's got the ISM at 42, and the Nasdaq has it about 36, 37. Right, so they're pretty much priced in the kind of recession that I'm looking for, which is more like a 1990s style recession than 2008. I think 1990 is actually a pretty good idea of what we're heading into. So if price includes all of the data, the forward-looking data, it's suggesting that the earnings are already priced in. We know that earnings have come down. So what is there that we don't know? This is what I can't get to terms with. The other thing is, a few people have written about this. I don't know if you guys have, you probably have, if you go back and look at earnings in inflation-driven cycles, they don't fall as much. Because there's this difference between real and nominal. We see it in retail sales, for example. So nominal retail sales holds up. And I think that there is a mechanism with it which that holds up earnings so they're less bad.
By looking at the Nasdaq and S&P 500 charts, it can be seen that the markets have already adjusted for the change in earnings. This is similar to the recession of the 1990s, where the earnings reports were good, yet we saw a very bad recession. Another point that Raoul raises is that in high inflation environments, earnings don't fall as much. This is exactly what we are seeing right now.
My guess is the same massive put buy that's rolling this put spread is the same one that did it in 2000 and did it in 2008, which was Norway. I'm guessing that's who it is. I don't know. So that's the Norwegian sovereign wealth fund. So that everybody is kind of set up the wrong way for this, and the issue is if this rate of change pivot, which I think is a better way of thinking about it, does cause the markets to squeeze. I mean, Christ, nobody owns this stuff. And that's a real problem. The other thing just to talk about in the equation, I know we haven't got a great deal of time, but in the equation is, don't forget the pension system. I've talked about this, ad nauseam. What is the pension system? Well, in Europe, it's relatively safe because it's bonds that run through full duration, right? So the mark to market in pensions in Europe is less bad. The US, it's the 60-40. You've just taken the biggest hit to 60-40 in over 100 years. Now, we saw the stress in the UK pension system because of its funding and the leverage that's involved to meet its liabilities. But the US has a bigger problem, and I don't think the Federal Reserve, who are all in their late 70s, mid to late 70s, the government, who are in their mid-late 70s, the Senate, who are in the mid-late 70s, want to see their friends or their own pensions decimated, and they're all going to get statements at the end of the year.
Raoul believes that the pension fund model in the UK is relatively safe because it consists of bonds, but even then, the UK government is having to step in to prevent a disaster. It is a whole different story with the US system, where the traditional 60-40 model is used. If things were to go sideways, which they will at some point, it will wreak havoc in the markets and the economy will suffer tremendously. Thank you for watching this video. Make sure to hit the like button and subscribe to our channel so you can stay up to date with the latest market news and events. See you guys in the next video.